most investors are watching the stock market tick by tick, debating whether the Fed will cut rates once or twice this year, the wealthiest people on the planet are doing something very different with their money. They're buying gold, quietly, deliberately, and in size. And they're not talking about it on financial television. They're not posting about it on social media. They're just buying. That silence should tell you something, because when billionaires move quietly, it usually means the trade isn't obvious yet, and they want to finish building their position before the crowd figures it out. Let's break down exactly what's happening and why it matters to every investor watching this right now. The first thing you need to understand is that billionaires and institutional investors don't buy gold for the same reason your neighbor buys a gold coin at a local coin shop. They're not buying it out of fear or panic. They're buying it as a calculated macro allocation, a deliberate portfolio decision based on signals they're reading in the global financial system. And right now, those signals are flashing in ways that serious money managers cannot ignore. Start with the debt picture, because this is where the story really begins. The United States government is running a fiscal deficit that would have been unthinkable a generation ago. We're talking about $1 trillion or more added to the national debt roughly every 100 days. The total debt load is now above $36 trillion, and the interest expense alone is consuming a larger share of the federal budget than at any point in modern history. We are now spending more on interest payments than on defense. Let that sink in for a moment. This is not a partisan observation. It's a mathematical reality, and it has profound implications for the dollar, for treasury bonds, and for the credibility of U.S. fiscal policy over time. Billionaires understand this. They have teams of analysts running these numbers, and what those numbers tell them is that the structural foundation beneath the dollar is showing cracks that cannot be easily repaired. Gold, historically, has been the asset that benefits most when confidence in sovereign debt begins to erode. Not because gold pays a yield, it doesn't, but because gold cannot be printed, it cannot be inflated away, it cannot be defaulted on. In a world where the primary reserve currency is being issued at an accelerating pace to finance spending that shows no sign of slowing, gold is the only truly neutral asset left on the table. Now layer on what central banks around the world are doing, because this is the piece that most retail investors are completely missing. Central banks globally have been buying gold at a pace not seen since the 1960 seconds. The central banks of China, India, Poland, Turkey, Singapore, and dozens of other nations have been steadily reducing their exposure to U.S. Treasury bonds and replacing that exposure with gold. In 2022, central banks purchased over 1,000 tons of gold. In 2023, they came close to matching that record, and 2024 continued the trend. This is not a one-year anomaly. This is a sustained multi-year structural shift in how the world's reserve managers think about their balance sheets. When billionaires see central banks doing this, they pay attention, because central banks are not emotional buyers. They are not reacting to headlines or quarterly earnings. They are making decade-long strategic decisions about the preservation of national wealth. And when those institutions collectively decide that U.S. treasuries deserve a smaller share of the reserve pie and gold deserves a bigger one, that is a signal of enormous weight. The de-dollarization conversation has moved from fringe academic discussion to mainstream geopolitical reality. Countries that once held the majority of their reserves in dollar-denominated assets are diversifying, not because they hate America, but because they've watched what happened to Russia's dollar reserves when sanctions were imposed in 2022. They saw $300 billion frozen almost overnight, and they drew a very rational conclusion. Holding your national wealth in an asset that a foreign government can freeze is a geopolitical vulnerability. Gold held in your own vaults cannot be sanctioned, cannot be frozen, cannot be seized remotely. That lesson has not been forgotten, and it is reshaping reserve management policy across the developing world and beyond. Ray Dalio, one of the most respected macro investors alive, has been vocal about his view that gold should be a core holding in any well-constructed portfolio navigating the current environment. He's not alone. Stanley Druckenmiller, Paul Tudor Jones, and other legendary macro traders have all made public statements or disclosed positions indicating meaningful gold exposure. These are not gold bugs. These are sophisticated, data-driven investors who have made fortunes across multiple economic cycles, and they're pointing at the same asset right now. Ask yourself why. What do these people see that the average investor scrolling through financial news doesn't see? The answer is that they're looking at a longer time horizon and a broader global picture. They're not asking what gold will do this quarter. They're asking what happens to financial assets broadly if the current fiscal trajectory in the U.S. is maintained for another 10 years. What happens to the purchasing power of the dollar if the Fed is structurally constrained from raising rates aggressively because the government can no longer afford the interest payments? What happens to bonds if inflation stays sticky and real yields stay unattractive? When you model those scenarios honestly, gold starts to look less like a speculation and more like a necessity. The inflation dimension here is critical and often misunderstood. Many investors assumed that once the Fed hiked rates aggressively through 2022 and 2023, inflation would return to 2% and stay there. The reality has been more complicated. Inflation did fall from its peak, but it has proven stubborn in the services sector, shelter costs, insurance costs, healthcare costs. These are not commodity prices that respond quickly to monetary policy. They are sticky, structurally embedded in the cost of living, and they are keeping real purchasing power under pressure even as the headline number improved. For billionaires who have spent decades watching inflation cycles, this pattern is familiar. They've seen what happens when central banks declare victory on inflation prematurely. They've studied the 1,970 seconds when the Fed eased too early, inflation re-accelerated, and the second wave was worse than the first. They're not willing to bet that this time is definitively different, and so they hold gold as insurance against the scenario where inflation proves more persistent than the consensus expects. There's also a currency dimension that goes beyond the dollar specifically. We are living in an era of competitive currency devaluation. When one major economy eases monetary policy, others face pressure to follow or risk their export competitiveness suffering. The European Central Bank, the Bank of Japan, the People's Bank of China, all of these institutions are managing their currencies in ways that involve, at various points, printing money and suppressing yields. In a world where every major fiat currency is being managed and manipulated to some degree, gold stands apart as the only monetary asset outside any government's control. Billionaires understand this on a visceral level because their wealth is large enough that currency risk is a real and present concern. When you have $1 billion, a 10% currency devaluation is a $100 million loss in purchasing power. Gold is not a perfect hedge, but it is the most time-tested hedge against currency debasement that exists across thousands of years of human economic history. That track record matters. Now let's address the argument that investors often make against gold. It doesn't produce cash flow. It doesn't pay a dividend. You can't value it with a discounted cash flow model. And that's true. Gold is not an income-producing asset. It is a store of value, a monetary asset, and it should be evaluated on different terms. The question is not what does gold earn? The question is, what does gold preserve? In periods of financial stress, currency crisis, or systemic instability, gold has consistently held its purchasing power while other assets eroded. That's its function, and that function has value even if it doesn't show up on a quarterly earnings statement. The smart money doesn't demand that every asset in a portfolio generate yield. They demand that every asset serve a purpose. And in an era of sovereign debt excess, monetary policy uncertainty, geopolitical fracturing, and stubborn inflation, gold serves a very specific and very important purpose. It is the anchor of last resort in a portfolio built to survive uncertainty. Look at the price action itself, and you see the fingerprints of institutional accumulation. Gold has made a series of new all-time highs over the past 18 months, breaking through $2,200, $2,300, $2,400, and beyond. And remarkably, it has done this in an environment of elevated interest rates, which historically would have been a significant headwind for gold. The fact that gold has powered through that headwind and continued to make new highs tells you something important about the nature of the buying. This is not speculative retail momentum buying. This is persistent, large-scale, institutional accumulation that is absorbing every pullback and continuing to push the price higher. When an asset makes new all-time highs while facing headwinds, and does so repeatedly, that is a signal that the buyers are large, patient, and not price-sensitive in the short term. That is the signature of smart money building a long-term position. For the individual investor watching this, the question becomes how to think about your own positioning. Gold doesn't need to be the largest holding in your portfolio, but the case for having meaningful exposure, not a token allocation, not a rounding error. But a real considered position has rarely been stronger in the modern era. Whether that's through physical gold, gold ETFs, gold mining stocks, or some combination of those instruments depends on your risk tolerance and investment objectives. But the macro argument for owning gold in some form is difficult to dismiss when you look at the totality of what's happening in the global financial system right now. The window of relative obscurity is closing. The narrative around gold has already started to shift. More mainstream investors are beginning to ask the questions that billionaires were asking 2 years ago. And when retail capital starts flowing into an asset that institutions have already been quietly accumulating, the repricing tends to happen quickly and significantly. The billionaires aren't buying gold because they're pessimists about the world. They're buying gold because they're realists about money, about debt, about the limitations of central bank policy, and about the history of what happens to currencies and financial systems when those limitations are tested. They've read the history, they've run the models, and they've made their decision. The only question is whether you're paying attention before the rest of the crowd catches on. This is Macro Signal Vault. Stay sharp, stay ahead.